There is a sickness of the mind that is so pervasive, so deeply embedded in the code of modern ambition, that we no longer recognize it as a disease. We have mistaken its symptoms for the very engines of success. We call it drive, we call it ambition, we call it being competitive, but it is a pathology. It is the validation sickness. It is the silent cognitive operating system that runs in the background of almost every high achiever, an algorithm that whispers a single, destructive command into the core of their being. Your worth is external. It is a number on a screen. It is a headline in a newspaper. It is the applause of a crowd that does not know you. It is the envy of people you do not respect. This operating system, this outer scorecard, forces you to leash your self-esteem from the opinions of others. And the rent is your potential. The rent is your peace of mind. The rent is your ability to think clearly in a storm. And ultimately, the rent is your fortune. This system is the reason brilliant founders chase venture capital valuations instead of customer value and burn to ashes. It is the reason intelligent investors buy at the peak of a bubble, terrified of missing out on the party, and sell at the bottom of a crash, terrified of looking like a fool. They are not making financial errors. They are making psychological ones. They are slaves to a defective codebase. A codebase that outsources their judgment to the mob. Now imagine a mind that has been cured of this sickness. A mind that generates its own validation, its own metrics, its own unshakable sense of worth and certainty, entirely from within. A mind whose equilibrium is not affected by the deafening roar of a bull market or the terrified screams of a financial crisis. A mind that can stand completely alone, in quiet conviction, while the entire world calls it a fool, and be right. This is not a hypothetical construct. This is the mind of Warren Buffett. And the architectural blueprint for that mind is the most important mental model he has ever shared, more fundamental than any concept of moats or margins of safety. It is the brutal, simple, and life-altering distinction between the inner scorecard and the outer scorecard. Buffett's $90 billion fortune is not a monument to his financial acumen. It is a testament to his psychological sovereignty. He did not outsmart the market. He surgically removed the market's opinion from his own brain. This is the deconstruction of that procedure. We will not just tell you what the inner scorecard is. We will dissect its architecture. We will uncover the psychological principles that give it power. We will journey through the historical battles where this mindset allowed Buffett to charge into the flames while everyone else was running out. And we will provide the framework for you to begin the difficult essential work of uninstalling the validation sickness from your own mind and building a new operating system based on the granite foundation of an inner scorecard. Prepare to re-architect your mind. Let us begin by diagnosing the prison you may not even know you're in. The outer scorecard is not a choice you make. It is the default setting for the human brain, supercharged by the modern world. It is an evolutionary relic, a survival mechanism from a time when social cohesion was paramount. To be cast out from the tribe was a death sentence. The desire for approval, the fear of ostracism, these are not weaknesses. They are ancient, powerful instincts. But in the complex world of modern markets and business, these instincts are a loaded gun, pointed directly at your long-term success. The system is built on three crumbling pillars: the neurological addiction to praise, the catastrophic pull of social proof, and the tyranny of the narrative. First, the neurological addiction. Every time you receive external validation, a promotion, a like on social media, a positive mention in the press, a stock you own going up, your brain delivers a hit of dopamine, the neurotransmitter of reward and motivation. It feels good. It feels like progress, and so you seek more of it. You begin to unconsciously optimize your decisions, not for the best long-term outcome, but for the next dopamine hit of external approval. A CEO might push for a short-term earnings beat that damages the company's long-term competitive position, all for the temporary validation of a positive Wall Street reaction. An entrepreneur might focus on metrics that look good to investors, user growth at any cost, rather than the hard, unglamorous work of building a sustainable business model. They are no longer business leaders. They are addicts chasing a chemical reward. The world is more than happy to be your dealer. The entire financial media complex is an industrial-scale dopamine distribution system. They praise the hot stocks and the celebrity CEOs, creating a feedback loop that rewards conformity and punishes independent thought. To operate on an outer scorecard is to willingly plug your brain into this machine and let it dictate your emotional state and, consequently, your decisions. Buffett understood this intuitively. His famous aversion to Wall Street, his decision to build his empire from Omaha, Nebraska, was a deliberate act of environmental engineering. It wasn't about geography, it was about neurology. He was unplugging himself from the dopamine machine. He was creating a space where the only validation available was the quiet satisfaction of his own analysis, proving correct over time. He replaced the short-term, addictive hit of market praise with the deep, lasting fulfillment of rational success. The second pillar of the outer scorecard prison is the catastrophic pull of social proof. This is the cognitive bias, where we assume the actions of others reflect correct behavior for a given situation. If everyone is running out of a burning building, it's a life-saving heuristic to run with them. If everyone is piling into a speculative asset with no underlying value, it is a wealth-destroying catastrophe. The psychologist Solomon Asch demonstrated this with frightening clarity in his famous conformity experiments in the 1950s. He would place a single, unknowing subject in a room with a group of actors. They would be shown a line on a card and asked to match its length to one of 3 other lines. The task was trivially easy. The actors, however, were instructed to unanimously give the same, obviously wrong answer. What Asch found was that over a third of the subjects would knowingly give the incorrect answer, just to conform with the group. They would override the evidence of their own eyes to avoid the psychological discomfort of standing alone. Now imagine this experiment scaled up to the global financial markets. The obviously wrong answer is buying a company with no earnings at a valuation of billions of dollars. The group of actors is the entire financial media, your friends, and the relentless upward tick of the stock price. The pressure to conform is immense. Your brain screams that if everyone is doing it, there must be a good reason. This is the psychological engine of every financial bubble in history. From the Dutch tulip mania in the 1630s, where a single bulb could be traded for an entire estate, to the South Sea bubble in the 1720s, which famously ensnared even the brilliant mind of Sir Isaac Newton, to the dot-com crash of 2000, the pattern is identical. The intrinsic value of the asset becomes irrelevant. The only metric that matters on the outer scorecard is the price action in the opinion of the crowd. Buffett's entire career is a case study in Asch-level nonconformity. He is the subject in the room who calmly states the correct answer while the rest of the group shouts the wrong one. His ability to do this is not because he is smarter, but because his scorecard is different. He is not trying to match the group's answer. He is trying to match the line on the card. His validation comes from correctly measuring reality, not from agreeing with the consensus. When the entire world was euphoric about tech stocks in 1999, he was publicly derided as a dinosaur, a relic who didn't get it. His inner scorecard, based on his unwavering principles of value and competence, did not give him permission to participate. He was willing to look like a fool to the crowd in the short term to be right in the long term. The outer scorecard operator is terrified of looking foolish, and in their desperate attempt to avoid it, they commit the ultimate folly. The third and final pillar of this prison is the tyranny of the narrative. The human brain is a storytelling machine. We do not process the world in spreadsheets, we process it in stories. The financial media understands this perfectly. They do not sell data, they sell narratives. The story of the visionary CEO who can do no wrong. The story of the new paradigm where old valuation rules no longer apply. The story of the inevitable decline of an old industry. These narratives are powerful because they are simple, emotionally resonant, and they spread like wildfire. The Outer Scorecard mind latches onto these stories because they provide a shortcut to understanding and a sense of belonging. If you believe the narrative, you are part of the in-group. Buffett, by contrast, is a narrative agnostic. He is a storybreaker, not a storyteller. His work is to ignore the compelling, simplified narrative and dive into the messy, complex, and often boring reality of the underlying business. He reads the full annual report, not the journalist's summary. He studies the decade's worth of financial data, not the chart of the stock's recent performance. He is looking for the plot holes in the popular story. In 1964, this narrative-breaking mindset led to one of the most formative investments of his career. The company was American Express. The narrative was simple and terrifying. The company was going to zero. A single customer of American Express's warehousing division, a company run by a con man named Tino DeAngelis, had perpetrated a massive fraud. DeAngelis had secured huge loans using barrels of salad oil as collateral. The only problem was, the barrels were mostly filled with seawater. When the fraud was discovered, the salad oil company went bankrupt, and its creditors, holding worthless warehouse receipts from American Express, demanded to be made whole. The market panicked. The narrative was that American Express's liability was potentially unlimited, that the scandal would permanently destroy its brand and its core traveler's check and credit card businesses. The stock price was cut in half in a matter of weeks. The Outer Scorecard screamed, "Sell!" The social proof was a stampede for the exits. The media narrative was a funeral dirge. But Warren Buffett, operating from Omaha, decided to break the story. He ignored the stock price and the headlines and asked a different set of questions, Inner Scorecard questions. First, was the core business still intact? He went to restaurants and travel agencies. He talked to clerks and customers. He saw that people were still using American Express travelers' checks and credit cards. The brand's value in the minds of its users had not been tarnished. The panic was contained to Wall Street, not Main Street. Second, what was the actual quantifiable liability? He studied the law and the company's financial position. He concluded that the company was strong enough to survive the hit and that its legal liability was far less than the market feared. He was replacing the terrifying amorphous narrative of unlimited liability with a cold, hard, rational calculation. Based on this deep, independent research, his Inner Scorecard work, he came to a stunning conclusion. The market, in its panic, was offering him the entire, magnificent American Express enterprise for a price that was less than the value of its investment portfolio alone. The core business was essentially free, so in the midst of maximum fear, he invested 40% of his partnership's capital into American Express stock. It was an act of supreme cognitive independence. Over the next few years, the investment became a massive success, helping to build the foundation of his fortune. The story of the salad oil scandal is the perfect parable of the two scorecards. The Outer Scorecard followers listened to the story, felt the fear of the crowd, and sold at the bottom. The Outer Scorecard operator ignored the story, did the work, and built a fortune from the panic of others. These three pillars, the dopamine addiction, social proof, and narrative tyranny, form the invisible walls of a prison that confines the ambitious. It is a system that promises success but is architected to deliver mediocrity. It ensures that you will always be a follower, never a leader, that you will buy high and sell low, that your best thinking will be drowned out by the noise of the crowd. To build true, lasting wealth and achieve genuine success, you must stage a prison break. You must consciously and deliberately uninstall this default operating system and architect its replacement. It is time to learn the principles of the Inner Scorecard. The foundation of the Inner Scorecard was laid for Buffett by his father, Howard Buffett, a stockbroker and congressman who valued intellectual independence above all else. But the concept was crystallized by a single powerful question that Buffett now poses to students. He asks them, would you rather be the world's greatest lover, but have everyone think you're the worst? Or would you rather be the world's worst lover, but have everyone think you're the best? The question is a profound diagnostic tool. The Outer Scorecard operator, without hesitation, chooses to be the world's worst lover who is thought to be the best. Their reality is external perception. The Inner Scorecard operator chooses to be the world's greatest lover who is thought to be the worst. Their reality is the truth of their own experience and competence, regardless of public opinion. This is not a parlor game. It is the fundamental choice that dictates the entire trajectory of your life and career. To choose the Inner Scorecard is to declare that your metrics for success will be self-created, that your validation will be self-generated, and that your judgment will be sovereign. It is the declaration of cognitive independence. This philosophy is not built on arrogance or on ignoring all external feedback. It is built on a radical shift in the asterisk source of your primary metrics. The Outer Scorecard looks at the stock price. The Inner Scorecard looks at the intrinsic value of the business. The Outer Scorecard obsesses over the quarterly earnings report. The Inner Scorecard obsesses over the long-term competitive advantages of the company. The Outer Scorecard asks, what does the market think? The Inner Scorecard asks, what do I think, and why do I think it? To build this system requires the construction of 3 new pillars: a foundation of self-sourced metrics, a ruthless information firewall, and a protocol for absolute emotional insulation. The first and most critical pillar is the definition and mastery of your own metrics. You must replace the world's yardstick with your own. For Buffett, the investor, this meant creating a scorecard based on principles he could control and verify, independent of the market's manic-depressive mood. His scorecard has a few clear, powerful items. First, have I accurately calculated the intrinsic value of this business? This is a deep, analytical process of estimating the cash a business will generate over its lifetime. The final number is his. It is the product of his own work. The market can scream that the price is twice that or half that. It is irrelevant. His anchor is his own calculation. His success is not determined by whether the stock goes up tomorrow, but by how close his calculation proves to be to reality over the long run. Second, does this business possess a durable, long-term competitive advantage and qualitative judgment, but one he has spent a lifetime honing? He is assessing the structural integrity of the business fortress. He is not interested in the popular story of the day. He is interested in the brutal realities of competition and capital allocation. Third, is the management team able, honest, and shareholder-oriented? He is judging character, a metric that never appears on a balance sheet but is often the most important variable of all. Fourth, did I purchase this business with a significant margin of safety? This means buying it for far less than his calculation of its intrinsic value. This is the ultimate Inner Scorecard metric. It is an admission of humility, a recognition that his own calculations could be wrong. He is building a buffer against his own fallibility. His validation comes from adhering to his process. The short-term price movements of his stocks are nothing more than the rantings of the crowd outside his window. He does not need their applause when he buys, and he is not wounded by their criticism. His satisfaction is in the quiet knowledge that he has followed his own rules, his own well-reasoned logic. This is the source of his legendary patience. He can hold a stock for decades, through brutal bear markets and periods of underperformance, because his conviction is not based on the stock's popularity but on his initial, unchanging analysis of the business itself. Let us examine another historical case where this pillar was tested by fire: his 1973 investment in the Washington Post. The backdrop was the Nifty 50 era. The market was infatuated with a group of about 50 large-cap stocks, companies like Polaroid, Xerox, and Avon. They were considered one-decision stocks. Buy them at any price and hold them forever. Their valuations were astronomical, driven by a powerful narrative of perpetual growth. They were the darlings of the Outer Scorecard. The Washington Post, on the other hand, was an afterthought. It was a newspaper company. an old media business in a world falling in love with new technology. And in 1973, the market was beginning to crash. The Nifty 50 stocks were collapsing, some falling by 80 or 90%. The entire market was gripped by fear. In this environment, Buffett began to buy shares of the Washington Post. From an Outer Scorecard perspective, this was madness. The narrative was that newspapers were a dying business. The social proof was that everyone was selling, not buying. The price action was a waterfall decline. But Buffett was using his own scorecard. First, he calculated intrinsic value. He looked at the Post's assets. He saw not just a newspaper, but a collection of powerful television stations and other properties. He realized that the entire company was selling in the stock market for about $80 million. His conservative valuation of the business, however, was at least $400 million, and probably more. He was being offered a dollar bill for 20 cents. Second, he assessed the economic moat. He saw that the Washington Post was the dominant newspaper in a major capital city. It had pricing power. It was an essential part of the community's information ecosystem. Its brand was a fortress. This was particularly true under the leadership of Katharine Graham, who had recently shown immense courage during the Watergate scandal. Third, he judged management. He deeply admired Kay Graham and her team. He saw integrity, intelligence, and a commitment to the long-term health of the business, not to the short-term whims of Wall Street. With his Inner Scorecard checklist complete, he acted with immense conviction, investing a significant portion of his available capital into the company's stock. The market continued to fall. His position initially lost money. To the Outer Scorecard world, he looked like a fool, but Buffett was serene. His decision was correct based on his metrics. The market's opinion was just noise. Over the next decade, that investment would multiply in value more than 100-fold, becoming one of the cornerstones of the Berkshire Hathaway empire. This is the power of a self-sourced metric system. It allows you to be rational when others are fearful. It allows you to see value where others see only despair. It is the essential tool for contrarian success. The second pillar required to support an inner scorecard is the construction of a ruthless information firewall. You cannot maintain a sovereign mind if you allow your brain to be flooded with the unfiltered, agenda-driven noise of the outside world. Your cognitive environment must be as deliberately architected as your investment portfolio. Buffett's life is a masterclass in this principle. He famously does not have a stock ticker in his office. He does not watch the financial news channels that provide a minute-by-minute commentary on the market's gyrations. He once said, "The stock market is a no-called strike game. You don't have to swing at everything. You can wait for your pitch." The endless stream of market data and opinion is an attempt to force you to swing at every pitch, to have an opinion on everything, to be constantly engaged. This is poison to the long-term thinker. It overloads your cognitive capacity. Cognitive load theory, in psychology, posits that our working memory is extremely limited. When it is filled with irrelevant information, the day's market chatter, a sensationalist headline, a pundit's forecast, there is no room left for deep, analytical thought. The Outer Scorecard operator lives in a state of perpetual cognitive overload. Their mind is a frantic, noisy place. Buffett deliberately cultivates an environment of cognitive quiet. His daily schedule is famously unstructured. He spends the majority of his day, up to 6 hours, simply reading. But what he reads is as important as what he doesn't. He reads annual reports, trade journals, biographies, and long-form journalism. He is seeking deep, factual knowledge about how businesses and the world work. He is building his circle of competence. He is not seeking opinions or forecasts. He understands that most of what is presented as information in the financial world is actually just marketing, designed to provoke an emotional reaction and a transaction. His information firewall is a direct defense of his inner scorecard. By controlling the inputs, he protects the integrity of his thought process. This leads to one of his most powerful mental tools, the too hard pile. When confronted with a business or an investment proposition he doesn't understand, he does not feel the outer scorecard pressure to form a clever-sounding opinion. He simply says, "It's too hard," and moves on. This is an act of profound intellectual humility that is only possible for someone who is not trying to impress anyone. The Outer Scorecard operator feels compelled to have a view on the latest tech trend, the newest cryptocurrency, the geopolitical event of the day. They are terrified of saying, "I don't know." Buffett weaponizes, "I don't know." He understands that his fortune will not be made from the hundreds of things he has a vague opinion on, but from the handful of things he understands with absolute, bone-deep clarity. His information firewall isn't about ignorance. It's about selectively directing his cognitive resources to the very few areas where they can generate extraordinary returns. Building your own information firewall means making conscious, often difficult choices. It means unsubscribing from the market newsletters that promise hot tips. It means deleting the stock market app from your phone that gives you constant price updates. It means replacing the time spent watching financial news with time spent reading the primary source documents of the businesses you seek to understand. It means cultivating a small circle of trusted, intelligent people who will challenge your thinking, not just echo your biases. A personal board of directors, much like Charlie Munger is for Buffett. It is an act of cognitive sanitation, and it is non-negotiable for anyone serious about independent thought. The third and final pillar of the Inner Scorecard is the protocol for emotional insulation. Even with the right metrics and a clean information diet, you are still human. You are still susceptible to the ancient emotions of fear and greed. The Inner Scorecard's final function is to act as a circuit breaker, severing the link between these primal emotions and your decision-making process. The primary tool Buffett uses for this is the mental model of Mr. Market. He learned this from his mentor, Benjamin Graham. He asks you to imagine that you are a partner in a private business with a man named Mr. Market. Every day, Mr. Market shows up at your door and offers to either buy your share of the business or sell you his at a specific price. The crucial thing to understand about Mr. Market is that he is a manic depressive. Some days, he is euphoric. He sees only a rosy future for the business and offers you a ridiculously high price for your share. Other days, he is suicidal. He sees only ruin ahead and offers to sell you his share for pennies on the dollar. Mr. Market is there to serve you, not to guide you. If he shows up in a state of euphoria, you are free to sell your share to him at a silly price. If he shows up in despair, you are free to buy his share at a bargain. And if his price doesn't make sense to you, you are free to completely ignore him and wait for tomorrow. The market will open again. This simple allegory is a profound psychological tool. It personifies the stock market, transforming it from an all-knowing, omnipotent force into a deeply flawed, emotionally unstable business partner. An Outer Scorecard operator believes Mr. Market is a source of wisdom. They feel happy when he is euphoric and panicked when he is depressed. They let his mood dictate their own. In effect, they become Mr. Market. An Inner Scorecard operator sees Mr. Market for what he is, a source of opportunity. His mood is irrelevant to the underlying reality of the business. Buffett knows the intrinsic value of his share. Mr. Market's daily price quotes are just noise, unless they present an opportunity to act rationally. During the financial crisis of 2008, Mr. Market was in a state of absolute suicidal panic. The entire global financial system seemed to be on the brink of collapse. The Outer Scorecard world was screaming, "Sell everything, hide in cash." Buffett, using his emotional insulation protocol, saw a different reality. He saw a terrified Mr. Market offering to sell him shares in some of the world's greatest companies, Goldman Sachs, General Electric, at prices that were absurdly low. While others were paralyzed by fear, he was acting with calm, calculated aggression. He published an op-ed in the New York Times titled, "Buy American, I Am." It was a public declaration of his Inner Scorecard's conclusion. He was not buying because he knew when the bottom would come. He was buying because his metrics told him that the long-term earning power of American business was being offered at a historic discount. He was ignoring his partner's suicidal mood and calmly taking advantage of the bargain. This emotional insulation is further strengthened by drawing on ancient wisdom, particularly the philosophy of Stoicism. While Buffett is a pragmatist, not a philosopher, his mindset is a perfect modern embodiment of Stoic principles. The Stoics, like Seneca and Epictetus, taught that the key to a good life was focusing on what you can control and being indifferent to what you cannot. You can control your own thoughts, your own analysis, your own decisions. You cannot control the economy, the actions of other investors, or the daily price of a stock. The Outer Scorecard is a recipe for Stoic misery, as it ties your emotional well-being directly to things outside your control. The Inner Scorecard is a recipe for Stoic tranquility. Your self-worth is tied to the quality of your own reasoning and the integrity of your own process, things that are entirely within your control. When you live by an Inner Scorecard, you can achieve what the Stoics called apatheia, a state of calm clarity, undisturbed by irrational passions. It is from this state of mind that the best long-term decisions are made. These three pillars, self-sourced metrics, an information firewall, and emotional insulation, form the unshakable architecture of the Inner Scorecard. It is a system for achieving cognitive sovereignty in a world that wants you to be a cog in the machine of public opinion. Building it is not easy. It requires conscious effort, discipline, and the courage to stand alone. But it is the essential work. It is time to move from theory to practice. It is time to begin forging your own Inner Scorecard. The process of transitioning from an outer to an Inner Scorecard is not a single event, but a lifelong practice. It is the mental equivalent of shifting from a diet of junk food to one of wholesome, nourishing meals. It requires breaking old habits, resisting temptation, and building new muscles. We can break this process down into 4 distinct, actionable stages: the audit, the declaration, the environment, and the practice. Stage 1 is the audit. You cannot fix a faulty operating system until you understand how it currently runs. This requires a period of brutal self-honesty. You must become a forensic accountant of your own validation sources. Take out a piece of paper or open a new document, and for 1 week, track every time you feel a surge of professional pride or a pang of professional anxiety. Next to each entry, write down the trigger. Was the pride from a compliment from your boss? A headline about your company? A project being completed successfully? Was the anxiety from a critical email? A competitor's success? A dip in a metric that others watch? Be ruthless. At the end of the week, look at the list. How many of your emotional highs and lows were triggered by external, Outer Scorecard events? How many were triggered by your adherence to your own internal standards of excellence? For most ambitious people, the results of this audit are shocking. They realize that their emotional state is being jerked around like a puppet on strings held by forces utterly outside their control. This audit is not meant to be an exercise in self-criticism. It is a diagnostic. You are simply mapping the existing code. An investor might ask, do I feel smart when a stock I own goes up even if I haven't re-examined the thesis? Do I feel foolish when it goes down? Do I check my portfolio value multiple times a day? Why? What information am I seeking? Or is it an emotional crutch? An entrepreneur might ask, am I more excited by a positive article in a tech blog or by a genuine, unsolicited email of praise from a customer? Do I measure my success by our latest funding valuation or by our profit margin? When I make a strategic decision, is my primary thought, how will this look to my investors? Or how will this create the most long-term value? A corporate executive might ask, do I prioritize the highly visible project that will get me noticed over the less glamorous but more impactful one? Is my decision-making in meetings influenced by a desire to agree with the highest-paid person in the room? Do I measure my worth by the size of my team or the title on my door? This audit is the essential first step. It makes the invisible visible. It reveals the chains of the Outer Scorecard so that you can begin to break them. Stage 2 is the declaration. Once you have mapped your current system, you must write the code for the new one. This means explicitly defining your Inner Scorecard. This cannot be a vague, abstract exercise. It must be concrete and specific to your field. This written document becomes your personal constitution, your anchor in a storm. For an investor, the Inner Scorecard might be a checklist printed and laminated on their desk. It would include items like 1. Have I analyzed at least 10 years of financial data? 2. Have I written down my full investment thesis, including what would have to happen for me to be wrong? 3. Does this business fall squarely within my circle of competence? 4. Is it currently trading at a significant discount to my conservative estimate of its intrinsic value? 5. Would I be comfortable holding this stock if the market closed for 5 years? The goal is to create a process that, if followed, will generate its own validation. Success is no longer the stock went up. Success is, I followed my process perfectly. For an entrepreneur, the Inner Scorecard could be a set of core principles about value creation. For example, 1. Are we solving a real, painful problem for our customers? 2. Is the product or service we delivered today better than it was yesterday? 3. Are we managing our cash flow to ensure long-term sustainability, not just short-term growth? 4. Is our team proud of the work they are doing? 5. Am I building a business I would be proud to own forever? This shifts the focus from external metrics of success, like funding rounds and media hype, to the internal, controllable metrics of building a genuine, lasting enterprise. For an executive, the Inner Scorecard might focus on impact and leadership. 1. Did my team grow in their skills and autonomy this quarter? 2. Did my decisions contribute to the long-term strategic advantage of the company? 3. Did I communicate with clarity and integrity, even when it was difficult? 4. Did I allocate capital, both financial and human, to its highest and best use? This declaration is your North Star. It must be written down. It must be reviewed regularly. When you find yourself swayed by external pressures, you must return to this document and recalibrate your internal compass. Stage 3 is the environment. As we learned from Buffett, cognitive sovereignty requires a deliberately constructed environment. You must become the ruthless curator of your own inputs. This is not about isolation, it is about insulation. Begin with an information diet. For 30 days, commit to eliminating all sources of low-quality, emotionally manipulative information. This means no daily market commentary on television. No scrolling through stock forums or social media for tips. No sensationalist business news. It will feel uncomfortable at first. You will experience a fear of missing out. This is the withdrawal symptom of the validation sickness. Replace that time with high-quality inputs. Read the primary sources. Read the annual reports of companies you admire. Read the biographies of great business leaders and thinkers. Read foundational books on psychology, economics, and history. You are not seeking a hot stock tip. You are seeking wisdom. You are rewiring your brain to crave deep understanding over shallow stimulation. Next, curate your social environment. Identify the people in your life who are Outer Scorecard amplifiers. These are the people who constantly talk about stock prices, who gossip about promotions, who define success by external symbols. You must lovingly, but firmly, reduce your exposure to these conversations. Simultaneously, identify your Inner Scorecard council. These are the 1 or 2 people in your life who you can have honest, intellectually rigorous conversations with. They are the ones who will challenge your assumptions, not just agree with you. They will ask, why do you believe that, instead of, what did the stock do today? These conversations are gold. They are the whetstone that sharpens your own thinking. This is the role Charlie Munger plays for Warren Buffett. He is not a cheerleader. He is an intellectual sparring partner who helps guard the integrity of the Inner Scorecard process. Stage 4 is the practice. An Inner Scorecard is not a belief. It is a muscle. It must be built through deliberate, repeated action. You must create small opportunities to practice thinking independently. One powerful exercise is to take a small amount of capital and make a quote-quote practice investment. Find a company that is deeply unpopular but which, based on your own research, you believe is undervalued. Write down your thesis in excruciating detail. Buy a small position. And then, do not look at the stock price for 6 months. The goal of this exercise is not to make money. The goal is to practice the feeling of holding a position based solely on your own conviction, without the validation of the market. It is to train your mind to separate the process of your decision from the short-term outcome. Another practice is to keep a decision journal. Every time you make a significant professional decision, write down what you decided, why you decided it, and what you expect to happen. This is not about predicting the future. It is about holding your own reasoning accountable. A year later, you can look back at the entry. The outcome is less important than the quality of your reasoning at the time. Was your logic sound? Did you overlook a key variable? This practice forces you to become a student of your own thinking. It moves the focus from the external result to the internal process, which is the very essence of the inner scorecard. This 4-stage process, audit, declaration, environment, and practice, is a framework for the most important work an ambitious person can undertake. It is the work of building a mind that is truly your own. It is a slow, difficult, and often lonely path. There will be times when the entire world is celebrating a trend you have abstained from, and you will feel the sting of being left out. There will be times when a decision based on your internal conviction will look wrong in the short term, and you will be ridiculed. This is the price of cognitive independence. But the reward is a prize beyond measure. It is the ability to think with clarity in the midst of chaos. It is the resilience to withstand the psychological storms that bankrupt others. It is the quiet, unshakable confidence that comes not from the applause of the crowd, but from the knowledge that you are living and deciding in accordance with your own well-reasoned, deeply held principles. It is the difference between a career spent chasing shadows and a life spent building something of substance. The inner scorecard is not merely a tool for making more money. It is a tool for building a more integrated, powerful, and authentic self. It is the final, essential ingredient that transforms raw intelligence and ambition into lasting, generational success. It is the master algorithm that allows all of Buffett's other mental models, the margin of safety, the circle of competence, the economic moat, to function at their highest level. Without the inner scorecard, these are just interesting ideas. With it, they become an unstoppable engine for wealth creation. It is the source code of conviction. And once your decisions are forged in the fire of your own independent analysis, and validated only by your own internal metrics, you earn the right to act with a level of certainty that is simply unavailable to the outer scorecard operator. You stop seeking the false comfort of diversification, the psychic safety blanket of owning 50 different things, so that no single mistake can hurt you too badly. You begin, instead, to hunt for the truly magnificent opportunities, the 1 or 2 decisions in a decade that can change everything. You begin to understand that true risk is not in concentration but in acting without genuine understanding. But how do you translate that profound internal conviction into a real-world investment strategy? How do you build a system that forces you to act only on these rare, life-changing ideas, a system that makes mediocrity impossible? Warren Buffett created a powerful mental device for exactly this purpose. It is a cognitive kill switch for the scattershot activity that plagues most investors. It is the ultimate expression of the inner scorecard philosophy, a framework for turning unbreakable conviction into a tangible portfolio. He calls it the 20-slot punch card rule, and it is the architectural blueprint for converting profound thought into generational wealth. To deconstruct that powerful system and learn how to apply its ruthless logic to your own ventures, click on the video now appearing on your screen.